Hi folks, this is Big Mike Zlatnik, and today's video is going to cover this really important topic. We're sitting effectively on a time bomb, high interest rates time bomb, and recording this right after Jay Powell gave an interview after hiking interest rates by another quarter. Now, the last hike doesn't really make material difference. Whether they did it or not, it didn't seem to, at least in my opinion, doesn't seem to make any real material difference. They had to proceed with this hike to maintain continuity and confidence in the system. He was calm and composed in the interview that he gave in the Q&A session. But I could tell you that Fed realizes that they have created effectively a time bomb, but they don't really have a choice. They had to fight inflation, and this is nothing particularly new. This has been a year plus worth of talk, and the action has effectively created a dangerous situation in the U.S. economy. We've seen cracks in the ice in the last few weeks, with Silicon Valley Bank collapsing and Signature Bank also folding. And as you start digging through the causes of these failures, it becomes pretty clear that interest rate increases in a very short amount of time, 1 year, going from zero interest rate policy, ZIRP, to where we are now, effectively at 5%, were just too damaging to the various parts of the economy, including the banking sector. Lots of banks are sitting on bad balance sheets. They're sitting on bad assets. Some of these assets could be classified as toxic waste, and some of these assets are just bad assets. It makes pretty simple sense. Banks generally try to invest safely, and investing in long duration U.S. Treasuries or similar mortgage-backed securities was considered to be a safe strategy. The problem was that these investments are very sensitive to the long-term interest rates. And as interest rates rose, the value of these investments fell. Not only that, this is the safe part of the bank portfolio. Some of the assets of banks are essentially toxic waste. What does that mean? Well, I'll give you some examples. So again, there's still a lot of speculation and uncertainty, but there are some rumors circulating that Signature Bank was sitting on a portfolio of loans that was called sort of toxic waste. These loans were loans to landlords on multifamily buildings in New York City that were effectively rent stabilized or rent controlled, where the landlords could not increase rents or only within the rent control guidelines, which are very, very small increases. Well, the interest rate spiked, the value of these buildings effectively collapsed. Why? Because the inability to raise rents due to government regulation and loan maturities could cause these loans to go completely bad. And there's no clear path to refinance these assets at all without some kind of subsidy from the government or other similar cash injection to stabilize these assets. So these loans are most likely substantially upside down, and banks would be taking losses on these loans if they were to foreclose or short sell these type of investments. So it's unclear exactly what the degree of losses would be, but it'd be substantial. And rapidly increased interest rates have caused that problem for the equity holders. They wiped out equity investors from the ability to refinance. And this is broad problem. The problem spans many, many, many parts of the U.S. economy. So if we go back to the 2008 crisis, which was very severe, but the economy wasn't as leveraged as it is right now. So after 2008, the amount of debt, both corporate debt, mortgage or real estate related debt, has grown substantially. So the growth of that debt at very low interest rates has created essentially a perfect storm where when the interest rates rose, the values of many of these assets has fallen or is falling, and there is substantial risk that we're going to see more and more failures in the system, corporate debt defaults, real estate developer problems, and so on and so forth. So the Federal Reserve is discounting the damage that they're causing because they are on a mission to fight inflation, which is important too. So it's kind of they're between the rock and a hard place. I'm not recording this to blame Federal Reserve. I actually have a lot of respect for what they do. I'm a big scholar of Federal Reserve and the actions, and I certainly appreciate Jay Powell as a very prudent leader, very smart. Unfortunately, he doesn't really have too many good options. He is squeezed between the need to continue to fight inflation, and on the other side, the damage that he's causing to the economy. And there's a risk of large problems in the economy. So we don't know how things are going to play out. And the Fed is known to be very reactive. They're trying to be calm and composed, but if there is a big problem that will surface, they'll likely step in and try to solve problems in an immediate and fast manner. That's what they did when the COVID hit. The amount of liquidity they pumped in and the ability to cut rates very fast was also clear and obvious support for the markets. So what do we do now? Well, we sit and wait. It's unfortunate, but not much we can do. The Fed has already done most of the damage. So again, it's not the fact that they're still pushing another quarter. It's the fact that where they've gone and how fast they've gone. So whether they would have been 4.75 or 5% or 5.25, it doesn't make that much material difference. It's just too much too fast. That's where we are. The big issue is how long they're going to keep interest rates at this level. And the Fed has signaled that there are no plans to cut rates later in the year. And I beg to differ. In my view, they'll be forced to start cutting rates because the bigger and bigger problems will start hitting various parts of the economy, more cracks in the ice for banks, more corporate debt problems, more real estate developer problems, and so on and so forth. So let's watch and see. For most investors, the time now is to raise cash or get access to cash or get access to liquidity to be able to act when these great deals start showing up. They're likely to start showing up sooner rather than later. So folks talked about second half of the year, late part of the year. We might see substantially interesting deals coming up as early as second quarter of this year. So be prepared, be ready. Great opportunities are coming to invest capital in distressed deals, buy distressed deals, transact in a manner that great assets will be available at discount. So time will show how big the pain is. It's just not going to be a soft landing in my view. Unfortunately, I think the risks of bigger problems outweigh kind of the confidence of the Federal Reserve that they'll be able to orchestrate with a soft landing. It's just unlikely with this amount of debt in the economy and the system and the speed of interest rates increases that we have observed. Anyway, stay tuned, stay educated. Appreciate your time and attention. We'll keep you posted on recent developments and looking forward to speak with you soon again. Thank you.